It's been a interesting 4 days here. Well, I'm 2 days into the interesting 4 days. Burgess's grandma is dying. She has ALS. And so Burge wanted to go out and see her while she's somewhat still there. So I am with the two little ones here for 4 days. Um, First time ever. It's 1-on-2. They've got the upper hand. And so I get to get them up in the morning and get them ready for school and get them off to school, and I get to put them to bed, which are, if you're not a parent, you probably don't know this, are the two most difficult times of the day if you have a 4-year-old and an 8-year-old. But I'm doing it, and I'm kind of thinking of it as meditative practice. It's easy to sit by yourself down when it's quiet and there are no distractions, but be that equanimous, centered person when your 4-year-old is hitting your 8-year-old and your 8-year-old is throwing food at your 4-year-old. And so it's great practice. Well, we certainly have stuff to talk about in the stock market. Stock market is very bipolar, very excited to go up, very excited to go down. And I want to take a step back and get some perspective on what's happening. And the perspective I want to use is, I want to use history. And I want to use about 85 years of history to kind of point out what's happening today. Hey everybody, this is RC Peck, and this is my weekend podcast. And the theme for this weekend is crashes happen. Now, I'm not that fond of the word crash. I like the word correction. I like the word fall. The word crash is just very hypey, but that's what most people call it on TV or cable or blogs or newsletters. So I'm just using the crash happen with two test dummies. Just to kind of be like, hey, crashes have happened for a long time. In fact, they've always been here. And if you're getting really freaked out about this one, really that's the biggest sign that you don't have a strategy that is expecting crashes to happen. So what I want to do is look at not only what is happening today, right now, but also go back in time and look at each decade and look at what happened each time that had a big crash. So with that, let me start with this price chart here. This is the S&P 500. And I've got three horizontal lines. The one at the bottom is the August low, which is also the October low of last year. And that's where the market got arrested, where it stopped falling. And then you see above it, and I'll just put my cursor up here, then you see above it here, this is the other line, and that is its lows in January. That's a big, it used to be a big support. Now it's acting like a resistance. And with Janet Yellen's statement yesterday, it didn't really do much. It still bounced off that line. And even if it would have gone above that line, the next major resistance, and that's a big resistance here. We got 1, 2, 3, 4, 5, 6, 7.5 months of resistance at this line. So we're going to see what goes on, but it could very well bounce between here with this move off this resistance. Now it's very likely it's going to come back down here and test the August low. So don't be surprised if that happens. Now what I want to do is look at past crashes or corrections and just kind of note that they happen. So here's the 2011 one. Looks kind of similar to it, where it fell, jig-jagged up, fell back down, broke below, and this is the day that Bernanke came out. Ben Bernanke came out and said, "Oh, we're going to print another 100 billion a month." And heck, the stock market likes that when central banks print money. So that was 2011. This is 2008. Huge fall over 19 months, fell 58%, and then it finally stopped in March of 2009. Zero interest rate policy and a lot of money getting printed. Then you have the 2000 crash correction fall of almost 50%. Notice it had a bottom here, had a double bottom here, and then that was its final low in 2003, and it took off from there, but it did a double bottom. So notice that you're going to find some double bottoms a lot. Also notice that's almost like a double top too. Then you have 1987. To me, 1987 looks very kind of similar, especially right here, to what's going on right now. Now, the lead up to this consolidation is much different than what's happening today. I mean, this move from here of the August high to the October low, that's a 34% drop. But this huge bar right there, that's 23% in one day, and then it consolidated, and then it actually moved up. Remember, though, in 1987, we were in a long-term secular bull market, a stable uptrend. We are not in a stable uptrend cycle today. We are in an unstable volatility cycle today. You got 1980 coming off 17 bad years. That's a really nice sloping, downward sloping trend. Not too volatile, but that was a loss of 25% over those 2 years. Then you got 1973, which fell 50%. So, yes, markets fall 50%. 2000 and 2008 was not the first time it happened. But just notice markets fall. 1968, look at this final drop in 1968. I mean, it was trending down, and just this final drop into May of 1970. Pretty impressive. That's 1968 when it started. And all these dates I have is actually when the market, when it peaked and it started to fall. This doesn't look that bad, all things considered. 23% still. It's almost 0.25% of your portfolio gone from, call it, February 1st to August 31st. In 7 months, you lose 1/4 of your portfolio. That would be pretty scary. Then you have this 1961 fall, correction, crash, whatever you'd like to call it. And to me, what's impressive about this is it really accelerates in March of 1962, and it only takes 1 to 3 months. 95% of the fall happened in 90 days or 60 trading days. That's pretty impressive. Volatility has always been here. Corrections of 25 to 89%, they've been here. Look at this one in 1956. Again, it's only 21%, but it happened in 1 to 3.5 months, 21% gone. Amazing. Then you have this one in 1946. What I like about this is it did a casual fall, and then it just cascaded down. And what I like here is it bounced down, like triple, quadruple top, quadruple bottom, and then it did move back up. So what the market is doing today, finding itself going back down to test the August low, going back up, testing that resistance point. This is normal. Expect back and forth. This is why it's good to study history. Here's 1939. We are in World War II. This is a huge gap down. I've got to believe that has something to do with the war. And then it kind of stabilized for a while and then fell again, 41% in 2.5 years. That is a significant fall. It was going on during the war. And again, huge fall, sideways movement for a while, and then another fall. Getting back to where we are today, it's going to move sideways for a while to decide whether it's going to finally go up or move down. 1937, 51%. Again, what I want to point out is this major fall, and then it went sideways for a while, trying to decide. The market is literally looking into the future and making a decision. Should I go lower or should I break high? And it took 1, 2, 3, 4 months, maybe even call it 5 months, and then it broke down again. So expect a lot of sideways volatility. That is normal for these types of corrections. And then, of course, we have the 1929 correction. Amazing, 89%. We were a merging market then. You see 80, 90% falls in emerging markets, which we were back in the early 30s. Look at Brazil today. It's getting absolutely crushed. They are kind of where we were back in the 30s. Coming online, a lot to add to the world, lots of commodities, but they're still super new. So the takeaways. Guys, we're in one of those situations now. The market was going sideways for the first 7 months of the year. It is clearly broken down. It is kind of deciding what to do. It's going up, it's going down, it's finding its ceiling, it's finding its floor, and it's going to do that for a little bit. So please stick to your strategy. Market probability will take care of you. It's got the long picture, the long view in sight, and volatility is part of the game. So what is the takeaway? What is the one thing? I will give you one thing, and that's from Ray Dalio, and you've heard me say this before. Expect a 50 to 70% fall. I am not saying this is going to be a 50 to 70% fall, but create a strategy, follow a strategy that expects to have a 50 to 70% fall, because all asset classes on the planet will fall 50 to 70% from time to time. But the takeaway, stick with the strategy. The strategy is smarter than us. It's not magical, it's not mythical. It's based on math. It's based on statistics. It's based on probability. It's based on history. And over time, it will absolutely take care of your money better than any other strategy I've ever bumped into or researched or read about. Now, if you have a lot of different positions, one of the things I'll say to you is it's okay if you're freaking out and you actually are losing sleep. The one thing I will say to you is it's okay to sell small positions. Better to be partially wrong than 100% wrong. And that's one of the principles that I use myself and that I use when I mentor or work or coach with individuals, is that if you're worried about a position, you don't have to sell the whole thing. You can sell 25% of it and wait a week, wait a month, and sell another 25%. Hey guys, that idea and the previous idea and ideas, they're just another step or another few steps in helping you protect your portfolio and protect your future. Until next time, this is RC Peck. Hey guys, I'm almost done building my diversification myth training webinar, which I'm super excited about. A huge amount of research has gone into it, showing you kind of what 145 years of history of studying markets, studying crashes, studying strategies has gotten. And clearly by the name of it, the diversification myth. Diversification is something that absolutely does hurt and kill people's portfolios and futures. So keep a lookout for the email that lets you know about that training, the diversification myth training, and I'll be excited to have you on that. You guys take care of yourselves, and I will speak to you soon.